Let's work through an example problem for perpetual inventory when we have returns involved. So this problem says that Kiwi Company uses the perpetual inventory system. The following information that we're given is for November of 2021. So on November 1st, we had a beginning inventory of 100 units at $5 a piece. November 3rd, we purchased 40 more units at $6 each. On the 6th, we made a sale of 70 units, selling each of those for $20 each. And then here on the 8th, we have our first return. So 10 of those units that we sold back on November 6th are now being returned back to us. On the 15th, we purchased 50 more units. And then on November 27th, we return 5 of those units that we purchased back on November 15th. So a lot of this is going to look pretty similar to any other perpetual inventory problem that you've worked on. What's going to change is what we see on the 8th and on the 27th. So let's work through FIFO first. So first in, first out for FIFO. On November 1st, we had a beginning inventory of 100 units at $5 a piece. When you multiply those together, that's how we get that $500. On November 3rd, we made a purchase of 40 units at $6 each. Remember, when you're working through FIFO and LIFO, you need to keep those inventories separate because we need to know which units came in first, which units came in last, so that way we know which units we are selling when. November 6th rolls around and we make a sale of 70 units. Now, the information in the upper left also mentions that we sold them for $20 each. That's going to matter if we are ever concerned with the revenue that we're making or the gross profit that we've made. However, when we're just working through to find our cost of goods sold and ending inventory, we can disregard that $20 per unit information. So instead, since it's FIFO, we are going to sell all 70 of these units at $5 each because those units at $5 each were the first ones to come in. So now they're the first ones to go out. So we sell 70 units at $5 each. And then we update our ending inventory on that day. Since we sold 70 of them, we only have 30 units left at $5 each. And then we still have all 40 of those units at $6 a piece. This is now when we see our first return. 10 of these units that we're selling here on the 6th are now being returned on the 8th. And this is how we want to write it out. So here in our middle column for cost of goods sold, notice that we have negative 10 because 10 of those units are now being returned to us. Those units were at $5 a piece. So when you multiply that together, you get negative 50. Then you can take a look at the updated ending inventory. Going into this day, we only had 30 units at $5 each. But now 10 of those were just returned back to us. So now we have 40 units at $5 a piece. And we have another 40 units at $6 a piece. On the 15th is going to look pretty similar to what we saw earlier on November 3rd. It's just another one of these purchases, right? So we put the purchase information over there on the left, the 50 units at $7 each for $350. And then we update the ending inventory on that day. We had 40 units at 5, 40 units at 6, and 50 units at 7. Now a purchase return. We're returning 5 of those units that we purchased back on the 15th. So over in our purchases column, we'll write out negative 5 at $7 each for a total of negative $35. And then notice what that does to your ending inventory there in the bottom right corner. it changes the amount of units that you have at $7 each. You still have all 40 at 5, you still have all 40 at 6, but we went from having 50 units at $7 each, now down to 45 units at $7 each. So your ending inventory here for FIFO would be the 200 plus the 240 plus the 315 that we see there on November 27th. Your cost of goods sold would be the 350 minus the $50 that we see in the middle column here under cost of goods sold. Now we can move on to LIFO. It's going to be pretty similar. We're just going to see a few different situations that could pop up. So November 1st, still the same, right? It's just our beginning inventory. November 3rd, still the same. It's just a purchase, right? FIFO and LIFO split off from each other at the point of the first sale. And that's what we're getting to now on November 6th. We need to sell 70 units here on the 6th. And now we're doing LIFO. So last in, first out. So we're going to need to sell those 40 units at $6 a piece before we can then dip into the 100 units at $5 a piece. We'll sell all 40 at $6 each. But then we're selling a total of 70 units. So we need to sell another 30 at $5 each. So we have those two different inventory groups here on the 6th that we're selling. And then that just leaves us with an ending inventory of 70 units at $5 each. Now, on the 8th, we have a return to deal with. This return is going to come from those units at $5 each. That was the last one that you sold. And so that's what we're going to take from here when this return is happening. So we'll write out a negative 10 at $5 each for a negative $50. And then we have to add those 10 units back in to our inventory. So we had 70. A customer returned 10 back to us. So now we have 80 units at $5 a piece. Now on the 15th, we made a purchase, right? So no different than what we see up there on November 3rd, where we write the information in our purchases column, and then we update our ending inventory over on the far right. But then here on the 27th, we have a purchase return. So we're returning 5 of those units at $7 a piece. It looks pretty similar to what we saw with FIFO, right? We write out the negative 5 at 7 over in the purchases column, and then we update what we have in our ending inventory. We went into this day having 50 units at $7 each, but after we made this return on the 27th, we only have 45 left. So your ending inventory on this day would be the 400 plus the 315 that we see there on November 27th. And your cost of goods sold, we look through the cost of goods sold column, we would add up the 240 plus the 150 and then subtract out that return of $50. Now we can move on to average cost. So we mentioned how FIFO and LIFO split off from each other at the first sale. Well, average cost splits off from FIFO and LIFO at the first purchase. Here on November 1st, everything's going to look the same, but then on November 3rd, things change. Right? Under average cost, we don't keep our inventories separate like we do under FIFO and LIFO. We combine those, and then we find what's called the weighted average unit cost. We find that number by taking the total number of units that we have, So if we initially had 100 units and just purchased 40 more, that's how we get the 140 that we see in our ending inventory. And then we need to add together the total values of those inventories. So the 500 plus the 240 gets us that 740. Then to find the weighted average unit cost, we'll take the $740 divided by the 140 units, and that comes out to about $5.29. Then on November 6th, we make a sale. So we sell 70 units at $5.29, which then leaves us with 70 more units at $5.29. So that's what we write out here on November 6th. On November 8th, we have a return. That return is going to be at that same weighted average unit cost that we made the sale at, right? So we will write out the -10 at $5.29, which comes out to about -$53. And then we just add those 10 units back into our inventory. And we add those $53 back into our inventory value. But notice, we did not have to calculate a new weighted average unit cost with a sale return. We will later on when it comes to the purchase return. But we don't have to do it here when a customer is returning goods to us. On November 15th, we made a purchase of 50 units at $7 a piece. So we have to update our ending inventory. We now have 130 units. They're now worth a total of $773. We divide those two amounts, and we come up with a weighted average unit cost of $5.95. Then a purchase return rolls around here on the 27th. We are going to write it out the same way over in our purchases column like we have for FIFO and LIFO. What changes is what we see over there in ending inventory. We have to update the number of units that we have. So if we had 130 and then returned 5 units back to whoever we bought them from, now we only have 125 left. If our inventory was worth $773, we returned goods that were worth 35. Now our inventory is only worth a total of 738, right? So we're just subtracting those values out. And then we have to find a new weighted average unit cost. So we take the 738 divided by the 125 to find our new updated weighted average unit cost of $5.90.